Hello, everyone, and welcome to the Deep Dive. Our goal here is to help you cut through the complexity of the financial world. We take key articles from the Seoul Economic Daily's financial section and, well, break them down into something easier to grasp, even when you're busy. And lately, looking at the financial news, it feels like some basic economic rules are being turned on their heads, things we thought we understood. Especially that fundamental idea, higher risk should mean higher interest rates. But that seems to be breaking down, doesn't it? We're seeing some really strange distortions ripple through the financial system.
That's exactly right. The Korean financial market right now is this mix of general financial instability and, very importantly, strong government pressure, things like total loan caps, real estate policies. It's all interacting in a way that's messing with the interest rate system we're used to. The usual logic just isn't applying. And because of this, we're actually seeing five pretty striking examples of interest rate inversions across the market.
5 different kinds of inversions. That sounds like more than just a market blip. It sounds almost like a warning sign for system instability. Let's dig into the most central ones first. You mentioned even the way banks set rates for home equity loans, H loans, you're showing odd signs.
Yes. The first case is how quickly the spread on variable rate H loans is widening. If you look at August, the gap between the actual H loan rate and the COFIX rate, that's the bank's funding cost benchmark, hit 1.59 percentage points. That's the widest it's been in, 2 years and 3 months?
Okay, so COFIX is their cost, and the gap above that, the add-on rate, is getting bigger. Normally you'd think, okay, banks want more profit. But you're saying there's a government shadow hanging over this.
Precisely. I mean, traditionally, that add-on rate reflects the bank's margin, maybe some risk management costs, but its purpose seems to have shifted. The government is pushing banks really hard to curb H-loan growth. So what are the banks doing? They're using the add-on rate almost like a lever to raise the overall loan rate, making it harder to borrow, which helps them control the total volume. It's less about pricing risk now and more about, managing regulatory demands. They're using the add-on rate as a tool for compliance.
Right, so the banks are artificially inflating the rates on these loans, the easiest lever they can pull, maybe just to meet the government's loan cap targets. And this leads straight into the second distortion, which frankly sounds the most jarring. Home-backed loans are now more expensive than loans to small and medium-sized enterprises, SMEs.
Yes, as of August, the H-loan rate edged just slightly higher, 0.01 percentage points, than the average SME loan rate. It's the first time we've seen that since April 2022. Now think about that logically. The delinquency rate for SME loans is 0.82%. For H loans, it's only 0.29%, much lower.
Wait, let me get this straight.
Yeah.
SMEs are almost 3 times more likely to default, yet their loans are cheaper than home loans, which has solid collateral.
Exactly. H loans should be safer and therefore cheaper. It's basic finance.
So banks are pricing the safer product higher than the one that's 3 times riskier. Isn't that a direct violation of the whole risk-reward principle?
It is, and it's probably the clearest sign of how regulation is just overpowering market logic right now. In the push to control H-loan volume, the lower risk product is actually becoming more expensive because of the regulations. It's, irrational from a pure market standpoint.
Wow.
And interestingly, at the same time, because of the government's shared prosperity finance push, rates on guaranteed loans for the self-employed have actually dropped. So you see targeted rate cuts in some areas, but the overarching loan caps are still warping the whole system.
Okay, so these distortions are then bleeding over into the secondary financial sector, the non-bank lenders. You said the third and fourth cases involve savings banks. We're seeing their loan rates go up even as the Bank of Korea's base rate went down, and their deposit rates are lagging behind commercial banks. And both are linked to one major risk.
That's right. It all comes back to worries about real estate project financing, PF, the potential for defaults there. Savings banks have significant exposure to PF loans, making them vulnerable. So even though the BOK base rate dropped from 3% to 2.5%, the average savings bank credit loan rate actually crept up from 15.27% to 15.5%. Why? They're basically trying to buffer themselves against potential PF losses by charging higher rates on other loans.
So the PF risk gets passed on as higher interest for regular people needing credit lines from savings banks. That makes sense in a grim way. But why the deposit rate inversion? Why are their savings rates lower?
It's the flip side of the same risk management coin. If you're a savings bank worried about PF defaults, the last thing you want is to attract a flood of deposits that you can't actually lend out profitably or safely. Taking in too much cash could just mean bigger losses down the line if those PF projects go sour. So they keep deposit rates low, sometimes even lower than major commercial banks. It makes it hard for them to attract funds, sure, but it limits their exposure. And this contributes to money either pooling in commercial banks or just sitting on the sidelines, unable to find a good return in the secondary market.
Yeah. So the PF risk effectively raises the cost of funds for the second tier, hits borrowers with higher rates, and even makes it less attractive for savers. A triple whammy, sort of?
Yeah.
And this whole climate risk aversion, regulatory pressure, it inevitably forces banks to get much, much pickier about who they lend to. Which brings us to the next point. This intense concentration of lending toward borrowers with near-perfect credit scores.
This statistic is really telling. In July, of all the new household loans issued by the five major banks, about 19 trillion won nearly half. 49% went only to borrowers with the absolute top credit scores, 951 to 1,000 points. That's almost 10 trillion won flowing just to that elite group.
49%. So basically, 1 out of every 2 new loans went to someone with a near-perfect score. How does that compare to, say, a few years ago? Has this flight to quality intensified?
Dramatically. Just go back to January 2021, that same top-tier group only accounted for about 27% of new loans. So in less than 4 years, their share has nearly doubled. And the flip side, borrowers with scores under 800, the mid to low credit range, they've been squeezed out. Their share of new loans plummeted from 11% last year down to just 5% this July.
Wow. That's clear evidence banks are just zeroing in on the absolute lowest risk borrowers, isn't it? The prime of the prime. Which means anyone with even an average credit score is likely getting pushed towards those much higher rates in the secondary market if they can get a loan at all. It sounds like an acceleration of financial exclusion.
It certainly looks that way. Banks have to operate within the government's DSR rules, the debt service ratio, which limits your total loan payments relative to your income. This DSR regulation inherently steers banks away from anyone perceived as even slightly higher risk, like mid to low credit score borrowers. So for a bank trying to manage risk and comply with DSR, the easiest, safest path is just lending to those top-tier borrowers. It ticks both boxes.
So regulations designed to enhance stability might be unintentionally making it harder and more expensive for ordinary people to access credit. It's a difficult balancing act.
Banks do push back a bit, mentioning credit score inflation, the idea that overall scores have generally improved, and there's some truth to that. The percentage of people with scores over 900 has risen. But the reality on the ground is that major banks are largely shutting the door on mid to low credit borrowers, and that itself shows how distorted things have become.
Right. And when the financial market feels this unstable, the focus naturally shifts to protecting customer assets and data. Which leads us to our final points. A tougher regulatory stance on IT security, and a quick look at global digital finance moves. First, the Financial Supervisory Service Governor's comments on fines for security breaches.
Yes, the FSS governor, Li Shenjun, recently made it quite clear. The philosophy now is that fines for things like data leaks must exceed whatever the financial institution spent on IT security. The idea is to make neglecting security much more costly than investing in it properly. It's about changing the financial calculation for banks.
So how big could the difference in cost actually be for a company?
Well, let's take a hypothetical. Say a company with a 12.8 billion won security budget has a major data breach. Under the stricter Personal Information Protection Act, the potential fine could be up to 3% of revenue, maybe hitting 80 billion won. Compare that to the maximum under the old Credit Information Act, which was maybe 5 billion won. It's a huge potential increase. The message from the regulator is clear. Invest proactively in security or face much harsher consequences.
A very strong signal to prioritize consumer data protection.
Yeah.
Okay, and lastly, quick note on KB Financial Group's global activities.
Right. KB Financial sent a delegation to the big GITEX Global 2025 tech event in Dubai recently. They had some significant meetings there, notably with Dubai's Virtual Assets Regulatory Authority, VARA, and the Dubai Silicon Oasis folks. They were discussing cooperation on digital asset regulation, crypto, and also collaborating on smart city innovation ecosystems. So even amidst all these domestic market distortions, you see major players like KB actively looking outwards, exploring global standards and future growth areas like digital assets.
So that wraps up our look at the distortions in financial market interest rates and the tightening loan thresholds. We'll be back soon with more updates. This has been the Deep Dive from the Seoul Economic Daily. Thanks for listening.